Good morning.
Good morning.
Welcome back to the Financial Shepherd Happy Hour. This is more like brunch, but this is Ezra. I'm Joshua Casey Garland, certified financial planner, owner of Shepherd Wealth Management. Ezra's, of course, our video editing genius. So all the things that we do on social media, certainly couldn't do it without Ez. So really appreciate all the work you do, brother.
Loving it. Appreciate the work.
Yeah. So we're here on Friday, right before, I don't know, the biggest week of earnings that we'll see this year coming up next week. So we'll talk a little bit about that. But the big reason why we're doing this show on Friday is just kind of recap what's happening in the market this week, why it happened, what can we look forward to next week, so we can prepare accordingly. And we're doing this show, usually we would do it at about 4:15 on a Friday, doing it today around 11:15 only because I've had this camping trip on my calendar from a year ago. I go every single year for about 2.5 days, just kind of getting out in the wilderness by myself with some other guys. So it should be a lot of fun. So we're going to give you this Friday happy hour a little early. So this is our brunch edition. So grab your coffee or your tea, whatever works for you.
Your preferred go-get-em juice.
Yeah, mimosas if you're not working. So that's awesome. I'm working right now, so I'm not drinking.
Or if you are working, a mimosa.
So we got earnings coming up, but so far I just want to kind of give everybody a little recap of the earnings that we've seen thus far. So about 17% of the S&P 500 companies have announced their earnings. That's about 87 companies. The median beat on the earnings per share has been 5%, and 75% of the companies that have reported have beat their earnings estimates. On the top line, so sales numbers, those that have reported their earnings thus far have a median beat on sales top line revenue of 3%, and 69% of those companies that have reported thus far have been beating their revenue estimates. Now, a lot of people might say, well, that has a lot to do with the impact of inflation. Things just simply cost more money. That is obviously very true. But the fact that these companies are not only beating on the top line, but beating on the bottom line with that earnings per share number in the face of and despite of all of these major challenges certainly is encouraging when you look at corporate America's strength, the unemployment rate being super low, and quite frankly, just because of all the stimulus dollars that were printed and handed out to business owners and people in this country, the balance sheets of individuals, households is as strong as it's ever been in recent history. So there's a lot of things to actually be positive about in a year so far that's been a whole bunch of negative. And that's kind of where I wanted to take rest of today's happy hour, I guess our brunch edition of happy hour, is how can I be bullish long-term about the market? How can I be bullish about things even in the face of all this? I get these questions quite often from viewers from the show, as well as clients when we do our quarterly reviews. And I even get these questions from Ezra sometimes, like, hey man, how can you even be bullish at all?
Yeah, it's definitely been difficult to continue, putting money into the market, the dollar cost averaging that we talk about all the time. I'm certainly a practitioner of that.
Yeah, we talked about that just before the show. And I bring this topic up because we just had a Bank of America fund manager survey, and it shows that institutional investors, which is the quote unquote smart money, it's the most underweight equities in 20 years.
Ooh.
That's a staggering statistic. However, what is the real big risk in the marketplace that we've seen all year long? The number one risk, I think everyone would agree, is the 40-year high inflation that we've been trying to overcome. And here is an interesting part of that inflation calculation. So truckload spot rates. So this is how in-depth we got to go here at Shepherd Wealth Management from a research perspective. When's the last time anybody has looked at truckload spot rates?
I don't have any response to that, but I'm just so glad we are right now.
So truckload spot rates. Typically, this is peak season for them, right? You guys send out all the pumpkins, all the Halloween decorations.
People start their Christmas shopping.
Amazon trucks are everywhere. You would think that the spot rate for truckloads would be at its peak because this is peak season for them. It's actually at a new cycle low. And what that would entail is that's a huge tailwind for the goods and services industry, obviously. That also would indicate that supply chain is normalizing. We're actually seeing supply chain being back to where it was in pre-pandemic levels. So again, the big concern is inflation. Well, a lot of the information here that comes in the inflation calculation is certainly falling like a rock. If we look at used car prices, everybody knows if you wanted to get a car over the last couple of years, it was, you know, if you were going to buy one, you're going to pay a nosebleed kind of
Oh,
price
yeah.
for it, specifically on used cars. And used car prices are down 10% year over year. However, the CPI shows that used car prices are up 7.2% year over year. That's a massive divergence.
Wow.
Why is that? It's because of the way that they do the calculation, and there's this big lag effect. We've been talking about this for I don't know how many weeks now.
Yeah.
It takes about 12, 18 months post Fed rate hikes to actually start to show up in the data. And these are, you know, huge parts of the CPI calculation. And by the way, the JOLTS report, or the jobs report, the Fed wants to see that get more normalized. Well, there's 5.4% decline in year over year job openings, and half the leading indicators for the CPI calculation are negative year over year, but yet we still see this hot CPI print, and it has everything to do with the lag effect. So if we look at the actual hard data in the real economy as it sits right now, and not necessarily too focused on the CPI, which is what the Fed's going to look at, we're going to hear from them on November 2nd in the afternoon with their announcement for another 75 basis point rate hike. Probably are going to have another one in December. That's what the markets are pricing in. However, the real data, the leading indicators are certainly falling like a rock. So for me, when I see all this stuff, yes, consumer sentiment is super low, and that's why you see, you know, 20-year low, underweight in equities. That's encouraging to me. I don't want to be buying a bunch of equities when everybody else thinks everything is going to go up and to the right. I want to be buying into equities when everybody else doesn't want to touch them.
Yeah.
As Buffett would say famously, we want to be greedy when others are fearful. And that's exactly kind of the situation that we're in right now, going into a massive couple weeks of earnings, followed by the Fed announcement. So everybody just buckle in. It's going to be a little bit of a ride, but ultimately with the data that we're seeing here, strong corporate numbers, as long as that holds true in the next couple of weeks from some of the biggest and most well-run companies in the world, the Apples, the Microsofts, the Googles of the world, Amazon, etc. They show strong earnings and good guidance. I think that we're going to have a very nice run here for the remainder of this year and into the beginning parts of next year. So I hope that's encouraging news for everybody that's watching this on Friday going into your weekend. We'll see what happens in the market today. So far, things have been relatively flat.
Yeah, a little bit of a maybe.
But it started out in the futures markets were down. I know all the major averages were down more than 1%, but then the Treasury 10-year started to fall from its yield price. So we'll actually see what happens here in a few more hours. But so far this week, we're pointing to a slightly positive week for the major averages. Not a big change this week, and that's kind of to be expected with a massive week of earnings followed by, you know, a Fed announcement the following week. So we'll see what happens here, but I hope everybody has a great weekend. If you're camping like myself, you got a beautiful weekend to do so. So I'm very much looking forward to it.
In the Ohio Valley.
Absolutely. And we'll all be watching the Bengals on Sunday. So go Bengals. Hope you guys have a great one, and we'll do this again next Friday. Cheers.